there's a 12 to 15 times demand. Do you think he's going to sit still and let that much demand sit there? No, he's going to figure out a way to fill that demand. And he's got the brains and he's got the money to do it. Trump was Trump and Harris was Harris and ABC was ABC and kind of what we all thought was going to happen. Although I did not expect the whole Trump was going to, save the cats of Ohio from being eaten by illegal aliens. That was interesting.
Cool stuff. So welcome back to the Intelligent Investment Show after a nice little little over a month break. Matt Dahl, ARPG in Las Vegas. Welcome back, brother.
Glad to be here. I missed you.
I missed you, sweetie. That's another nice hair day. You are really hitting on something with the hair nowadays. I don't know. See, I have a new hair day every day, right? I don't think I ever have the same hair 2 days in a row or even 2 hours in a row. But I mean, you are a stone cold assassin, the exact same every single time I see you.
It's a helmet. I actually just put it on every morning and I staple it. It kind of just clicks on, I'm like a stormtrooper. I just put it right on there.
I'm just picturing you like when you race and you get out of a car. Like I'm picturing you get the helmet off, hair looks the exact same, like nothing changed.
Actually, I don't need to wear a helmet. So SFI and the Snell helmet rating agencies have actually tested my hair. And they're like, no, you're good. It's better than any helmet we've ever seen manufactured. So just go for it, bud. Ding, ding, ding.
That is awesome, man. Well, I'm excited to get back at it here. It's been a little over, I think this is 5 or 6 weeks since our last show. And we were talking yesterday. Basically, you could take the S&P 500 chart where we left off August 2nd or August 5th, whatever that was. You just take that chart and then just draw a V at the end of that chart, and that's pretty much where we are now. We pretty much immediately jinx the market. It goes down, has this little silly season, as you called it yesterday, and now we're basically right back more or less where we left off. So what happened? What wrote the V?
So what we had obviously that labor report come in on August 2nd, right? 180,000 jobs was consensus. We had 114,000, and we had revisions lower of the previous 2 months. And obviously that all of the recession is coming, the labor market's imploding, bears came out of the woodwork, and yields dropped, and there was a sell-off that happened that Friday. And then subsequent to that, and I think we discussed that day. And I thought the market could actually get down to 52.50. And that's actually effectively where it really got to, save that one day, which was August 5th, which was that very next Monday. Okay, when we had that sort of that flash crash from the Japanese when they unexpectedly raised interest rates, which caused a massive implosion of what they call the yen carry trade. A lot of equity sold off in those like margin style accounts. Okay, and I remember it was that Sunday night I was in the futures, and I'm like, and I was just kind of took a casual look at the futures, and I'm seeing the NASDAQ down 800 points. I think to myself, what in the actual what is going on here? And I started, and I saw the blip that said Japan unexpectedly raised interest rates. And I thought, okay, well, and then they started talking about the yen carry trade, something I'm really not all that familiar with. And I don't think many people were until everyone became, experts at the yen carry trade overnight, right? So what the yen carry trade is pretty simple. So with the ultra low interest rates that Japan has had for many, 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 many years, right? You could effectively buy assets in that currency. That's all it was. So you go to Japan, you would buy high yielding stocks or high yielding bonds typically, or good dividend paying stable stocks that, 5 or 6%, or even margin accounts where you're borrowing that money to buy growth stocks like Nvidia, whatever it is. Okay. High yield bonds, anything, but you're buying it at basically 0 or, 0.5% or 1%. If you buy them here, you're paying 4, 5, 6% on those margin accounts. You're paying more money to borrow the money to buy those positions. Well, in Japan, you're spending much less money, so you have a much wider gap, if you will, if you're buying the HYG, right, a high yield bond index, that pays just under 7%, about 6.5% these days. Okay, so if you're buying it in the United States on a margin, you're paying north of 5% for that. So your net differential in income is almost non-existent. You're hoping to get price appreciation through bond, but then the yield comes down, and so it's kind of at some point you're kissing your sister, right? Or you can do it on the yen side, and you're getting an automatic 5% income. So that was a big part of the unwind, right? So that's what took place. And it was pretty quick. It was pretty violent. But then what happened subsequent to that was pretty interesting. It was interesting / predictable, right? Yields went through that. We were kind of living in that 390 range, 385, 4% on the 10-year, right? The 2-year was sort of living in that 4 to 410 range. The labor reports came out. We saw some cooling in retail spending. And then, bam, we've seen yields have come down. So then the market turned around and went the other way. And we actually finished August 56.28. Not an all-time high, but 0.2% away from an all-time high, 0.3% away from an all-time high. We finished August. So we were at 51.19 August 5th. We finished 56.28 end of August. Okay. What got wrecked in that month? What got wrecked was tech. Tech got absolutely obliterated. Okay. And I think that had to do with one very simple thing. Okay. When rates started to come down because of the weaker labor market, what stocks became more attractive? Your dividend payers, right? Because those are what's in competition with the fixed income market. Rates come down. And what happened is they rotated from your tech, your growthy names, to your dividend paying names. And so what brought the market back and what led the market in August was real estate, consumer staples, and utilities. That's what led the market.
That led the market in August.
Correct. That's what led the market in August and what led it back. And so now we are seeing a little bit of an unwind of that. The CPI that came out this week and the PPI came out this week. It was fine. It was actually on the core side, month over month, was a little bit warmer than they expected. 2/10 versus 3/10, right? 2/10 consensus versus what we got was 3/10. Not bad, but what it showed us, this economy is not dead by any means. It's normalizing. We've talked about the normalization process, but it's not dead by any means. The other thing is we also had the jobs come out last Friday. Okay, they came out. It was 142,000 on 170,000 consensus. So that came in a little bit light, which caused yields to go down a little bit more. But they've sort of stabilized here. Now we're starting to see the 30-year fixed is at its lowest position, its lowest point in 20 months, right? We haven't seen rates like this since February of 2023. So those are good because that's going to unlock a lot of wealth in the United States. There's a lot of people that have bought homes in the last 2 years and those prices have increased and they've not been able to access any of that value because of the higher interest rates. It's funny, there was an article and it talked about August being the most volatile month in years, probably since March of 2020. And that's what it was. It was just this, we had an ugly jobs report, then we had the interest rate increase in Japan, and then we had a massive rotation. And it all happened within a week of each other, right? And now we're starting to see that whole system kind of unwind a little bit, if you will, right? Tech has absolutely it's coming back with a vengeance, right? We're starting to see tech outperform. If you look at the equal weight tech sector versus the equal weight S&P, tech has turned around and gone the other way, which is kind of what we thought because if you look at tech, those have higher multiples, so their earnings are a little bit further out, right? So I think the bond market has really assured the higher multiple tech side that those earnings are going to have plenty of purchasing power for you.
On the yen carry trade, this is one of the really interesting things about investing in economics.
I'm going to warn you real quick. I am no expert on the yen carry trade, so
but there's
tread lightly. I might just start drooling.
I'm not going to dig deep in testing your knowledge on this, but there's just a simple concept that you may have some feedback on. that I think gets missed a lot of times. So what's happening there, if I'm understanding that correctly, and this can take place, Japanese investors could do this, U.S. institutional investors. I mean, I think even a U.S. retail investor with an Interactive Brokers account could do this. If you have currency trading in your account, you could do this. You're basically choosing to buy these stocks, but instead of paying cash, you're paying yen for that. And then the advantage to that is you're essentially borrowing yen at 0% to buy the stock. But then you start to get into this funky little currency conversion thing where now when you sell it, you're getting yen back for it instead of dollars back. So what's interesting is that, where I'm going with it is, I hear that in a vacuum and I say, okay, well, why would you want to buy it in dollars and pay 5% when you can buy it in yen and pay 0%? But a lot of investors think that, it's a free lunch, free ride to buy it with the yen versus the dollar. But then the flip side of that is when you go to sell it down the road, there's a potential at least that the yen may have depreciated versus the dollar over that time frame because of the surplus of availability of the yen versus dollar because of the lower interest rate. It can end up undoing the advantage you thought you were getting because the higher interest rate makes the dollar stronger versus the lower interest rate could end up creating a weaker yen versus the dollar, and it all kind of washes itself out in the long run. So I'm not drilling you to that or nailing you to that on all of the particulars of that, but the general thing that I'm trying to say there is there are no free lunches in investing, right? Whatever it is that you think is special about this, this stock is 2 times earnings. That's a really cheap stock. Well, it's probably a really good reason it's 2 times earnings, right? So there's always some backside of that coin that we don't think about sometimes. Is that fair?
Yeah. So what you're getting at is, okay, so if you buy this, if you convert your dollar to yen and then you now purchase these same assets in yen and you're not you're getting the money for free versus paying the 5% in the U.S. for exactly the same money. You're hoping that the yen doesn't depreciate more than that differential against the dollar over the period of time that you owned it. So the fact that we are in a rate cutting environment and Japan is effectively in a rate increase regime, that lets you know that the dollar yen is probably going to be tightening a little bit. More than anything, the dollar is going to depreciate a little bit against the yen. So, I would think that would be an okay situation, but I'm certainly no expert on currency and as far as that's concerned and how it impacts. Everyone knows how volatile the dollar yen trade is. The yen is. I mean, it plays Megadeth on Tuesday mornings in their mom's garage, with their grandmother watching the Price is Right. The yen moves around. It's nuts. Yeah. It's lost its mind. It's always all over the place. Okay. So you have to be, I would think, and hats off to those currency traders and those currency managers who are really, really good. There's a lot and they're good, who understand the interplay between the differential of the cost of money on the yen versus the cost of money on the dollar and the potential impact that the currency differential will have over the ownership period, over that what they call, I guess, an outcome period, right? So that is I would imagine is a discipline in and of itself that probably takes a bunch of gray hairs and a whole bunch of mistakes to get good at.
Yeah. Well, don't worry. We're not going to rebrand as the Intelligent Currency Show anytime soon. So we're not going to make this a habit. I just wanted to dive on, explore that just a little bit. That there's always some other domino that you haven't thought of as an investor.
Always.
Another question.
No, you're 100% right. There is no free lunches.
Yeah.
And you see that sort of with the day traders and the meme stocks and that clown who gets on there, Fat Kitty or Ugly Kitty or Fat Cat or whatever the hell his name is. They made it whatever. You know what I'm talking about, right? The guy with GameStop. Okay.
Yeah, I know of it.
Basically made the whole world believe that, hey, this is easy. Just do it like this.
The only thing that I ever do on social media is post our stuff to it, right? Like I can't look at people. I can't see what other people put out. It makes me worry about all kinds of stuff, basically the future of human civilization. I heard a great joke the other day. I heard a comedian talking about the different generations, and they were laughing at Gen Z and saying that if Generation Z ever takes over the world, it's going to be super easy to get it back because they don't know how to do it.
Yeah, right.
for themselves. So that was great. I
You know,
love
it's funny. And I don't want to take over your moderator position.
that. Please do.
But we were having a meeting this morning here, and we were talking about peak income and spending years in the different generations, and what we think is going to happen as rates go down. Blah 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 blah. Just our Friday meeting on markets, economics, so the advisors can articulate to the clients, what the thesis is, what the narrative is, what's going on. Because we're an in-house money manager, we don't do the, here's a mutual fund, pick which one you want. We're the actual money manager. And we started talking. We spent a lot of time talking about the millennial generation, your generation. Okay, now the advisors and our new practice administrator. Actually, she's our registered CSA. She's new to the team. She's great. 30, 31, and 33.
Yeah.
And yeah, so they're millennials. And I thought, the millennials 10 years ago were getting a pretty rough rap. The millennials, they're living in their mom's basement. They're this, they're that. However, millennials, first of all, they're bigger than the baby boomers. They're 98 million versus 88 million, the baby boomers, versus our tiny generation, Gen Xers, the hose water generation, right? So, and the millennials have a higher demand curve than the baby boomers. The baby boomers have typically been where the generation, they access credit, they wanted a job with a pension, they got a job with a pension, they bought a home, and they lived their life. Well, the millennial generation, and of course Gen X, but the millennial generation, most of them, 90+% of them, didn't get a job with a pension. Right? They went to work and they have 401k or started their own. And they're a very entrepreneurial generation, in my opinion. And they're I think they're smart, and they grew up in the information world. Okay. So they've had easy access to a tremendous amount of information, which, I can't imagine having the access to what we have now when my brain was 9 years old, 8 years old, 12 years old, when it could absorb things and, do all those things that a young brain can do. So at some point you got to think that, they're pretty smart, and there's enough of them. There's enough of the millennials where I think we're going to have a pretty stellar run into their peak income and spending year, which will be 2038. Now, there's always going to be chops and movement and choppiness in the markets, and nothing's ever linear, right? Nothing ever goes in a straight line. Earnings are going to dip here and there for sure. But I think for the most part, the U.S. is in really good shape, not just because of the quantity of the size of the millennial generation, but honestly the quality. They're entrepreneurial. They make decent money, and they're used to having things, and they're willing to work for it for the most part.
That's an interesting point, because I hear the same things you hear. I mean, this Comedians Act kind of went through all the generations, and not specifically trying to be so condescending towards the younger generations, but you could definitely tell as they got younger and younger and younger, it was less and less complimentary to each generation. But one thing you got to remember is, I bet if you rewound the clock 30, 40 years, the baby boomers and the great generation, or whichever one came before the baby boomers, probably didn't have a very high opinion of Gen X at that time when they were 20 years old, right? As we grow up and we mature, millennials are getting a little bit more mature, and we're learning how to hold our own with some things, and Gen Z will eventually get to that point. So it'll be interesting to see, but I agree with that. I hear what you're saying there. I think that's a good point. Another random question. I'm like all over the place today, man. These questions don't necessarily have any relation to one another, but you mentioned dividend, or the high dividend paying stocks, utilities, consumer staples, and what was the third one?
Real estate.
Real estate. How rare is that? Because typically in at least in a stereotypical market cycle, those stocks may lead the market in a down market. When the market's down 25%, they may only be down 6%. But it's pretty rare to see those lead a recovery or a rally. Is that a fair statement, and what does it mean that they did that?
Well, so yeah, they're going to lead the market in an interest rate reduction environment. When the market's going up and everything's going up, obviously the companies with the highest earnings growth, right, as it relates to their multiple, are probably going to do the best. But when that trade has gotten overcrowded and somewhat exhausted. And then there's a again, back to the football field, there's a fundamental change. Something moves it to a different chunk of the field, i.e. poor labor reports that moves yields down, that obviously now the fixed income is less competition for those dividends. That is the recipe for a rotation, right? So markets, as you look at markets, we know they don't go up in a straight line, but the sectors within the market, they don't all move together, right? And how rare is it? I mean, it depends on the spot in the calendar that we're at, right? So if we're in a slow growth environment and interest rates are down, that's probably a good place to be. Okay, you're going to want to stay away from financials. You're going to want to stay away from energy. You're going to want to stay away from cyclicals like industrials. However, you're going to want to be in your maybe your real estates, or you're going to want to be in your utilities, your consumer staples. The other position you would want to be in would be your growth positions. Okay, I know that sounds counterintuitive, but you have to look at the juxtaposition of the two. Interest rates are down, so your dividend payers are going to do well, right? Because they're going to get income over there, fairly stable income, versus the fixed income market where they're going to get very little income. Also, with a slower growing economy, there's not going to be a lot of materials aren't going to do well, industrials aren't going to do well. Those aren't going to do well because there's not going to be a lot of early cycle type or growth in the economy. So you have to look at the growth sector of the economy to get your growth, okay? And then really deep sort of peek under the hood and look at the companies in there that have the strongest growth in those sectors, and then see what you're paying for that growth and then make a decision. Because if there's very little growth in the economy, you have to look to those growth sectors to do well. And that's why growth actually does pretty well in your slower growth economic environment.
Right. So since we talked last, I believe when we took our break, we were about halfway through earnings season. There was one big name that still had not reported, and it's maybe, I don't know, arguably the biggest. NVIDIA has reported since we chatted last. What was the takeaway from NVIDIA? How they doing? How they performing? And what are your thoughts? What's in Matt's big brain on NVIDIA nowadays?
Oh, of course, they did exactly what we thought was going to happen on August 2nd. They knocked the cover off the ball. I don't have the numbers right in front of me right here, right now, but they exceeded earnings and they increased guidance, all of those things. But it shows you just how far expectations went. They pulled down from 140 to right about $104. So they pulled down 30%. Right, they're back up about $120 today. So, but there has been 21 instances where NVIDIA has pulled back more than 25%. It just happens. It's just one of the stocks. But I mean, you're looking at their growth rate of 30%. You're looking at a multiple of 37 times. You're looking at, cash on the books of $26 billion. You're looking at just massive cash flows. There was a webinar that I attended a few days ago, and NVIDIA's Blackwell chips. Listen to this. I actually had to replay it to make sure I heard it right. Okay. The Blackwell chip has, at any given week, right, there's a 12 to 15 times demand on those Blackwell chips. So for every one they can make, there's a 12 to 15x demand on that chip. Now, The genius that is Jensen Huang, do you think he's going to sit still and let that much demand sit there? No, he's going to figure out a way to fill that demand. That is one super smart guy, right? And he's got the brains and he's got the money to do it. Because if you're one of the companies who wants a Blackwell chip and you can't get one for 3 years, well, AMD's got one. It's pretty good. Might not be that good, but it's really good, and it will do the job.
Right.
Okay? And it's also less money.
Yeah.
Right? So they're not going to let those potential sales rot. Because I remember this when I was an analyst at Pepsi. One of the district sales leaders, we had a talk. He was this old man. I love him to death. He was funny as hell. And he said, every time somebody walks by and they pick something up and we don't have something on the shelf, and they buy something else, we lost that sale. We're never getting that sale back. Ever, ever, ever. And that's how we thought. And he was actually a retired business owner. He was actually pretty successful. And then he came to work for the Tropicana side of Pepsi. And he did a phenomenal job because his brain just thought in those ways. And he just, and I actually learned a lot from him.
Yeah.
I'm sure that's how Jensen Huang thinks is, okay, no, we're still going to do great. We're still going to, have a great stock price, and we're still going to sell a ton of these Blackwell chips. We're still going to transform the world with our AI, but we'll never get that sale back.
Right. No, that's a great point, and I think it's and golly, think about the opportunity for the fastest growing company out there to add practically a zero to their growth rate. If you've got that much demand that's being unsatisfied, that'll be interesting to see what they come up with to satisfy it. Other thing that's changed, I suppose, we hadn't really talked about it too much. The election cycle is just getting, we're getting closer and closer. We're less than 2 months away now. There was a debate last week, I think. I didn't even watch it. Does it matter? Like, has anything changed? I mean, we sort of had a playbook, okay, this is what the market sort of expects with Biden. This is what it expects with Trump. And then I don't know that Harris coming in over Biden necessarily made a big change. Has anything happened in the election? Has anybody said anything that the market happens to believe that changes the narrative, or is it just the same thing that where we left it off?
Yeah, so the debate on Tuesday night, right? That, I watched it. I don't think it was a needle mover either way. Trump was Trump, and Harris was Harris, and ABC was ABC, and kind of what we all thought was going to happen. Although I did not expect the whole Trump was going to, save the cats of Ohio from being eaten by illegal aliens. That was interesting. But, I'm glad he's going to save the cats, which is pretty cool. It's going to be a close election. It's just going to be a close election, and whoever wins, we're going to deal. We're going to invest in the market that we have, regardless of who wins, not the market that we want, depending on who we think we want, right? And, whereas in our meetings here that we have here, we talk about the differences, and if you're pro-Trump or you're pro-Harris, understand, okay, there's differences, there's pros and cons to both, okay? I was here and I managed money through the Trump years, okay? And the economy did really, really good. However, we had 2017, which was a really great year, right? We cut corporate taxes. I remember we talked about this before. The VIX that year was like 9. I mean, there was no volatility. The market just went up. I mean, it was great. We just got to come into work and just, watch Lord of the Rings or whatever we wanted to do because there was nothing on. New money, we just invested great. 2018 happened and the market was doing well. The economy was doing well. So then Jay Powell came in as the Federal Reserve Chairman and basically said, hey, we're going to start raising interest rates because if we don't, the economy is going to go nuts, right? And we're going to get inflation. So then we had the 2018 crash. Then we had 2019, which was the trade war. And the market did okay up until about, August, September or so. Then it really took off. And then, of course, we all know what happened in 2020, right? So we had good years, but there was some quite a bit of chop to it, specifically 2019. 2019 is spoken about in a very sanguine way. Oh, the great days of 2019. Though that was a choppy year. Okay, it was a good year. Don't get me wrong. I want to say it finished near 30% that year, but it was mostly done in the fourth quarter. That was a fourth quarter year, right? Because of the trade war with China. And I remember coming in that year and it was like, he says something, we're going to get these tariffs of China. He says China, and you just watch the market go berserk, right? So there's going to be, I think if Trump wins, there's going to be more volatility. There will be lower taxes. Now he wants to not tax overtime now. Okay. I've not peeked under the hood of the federal budget all that much, but what I think the two environments will be similar in a lot of ways, but the differences I think will be again, more volatility with Trump. I think he's going to cut taxes in multiple ways. He's going to lower the corporate tax rate from 21 to, he's saying 15. It'll probably end up as 18%. So initially, he's not going to tax tips. He's not going to tax overtime. So I think initially you're going to have lower receipts to the Treasury, okay, which will probably have initially higher deficits unless he gets spending under control. But he's saying that he also wants to put tariffs on that's going to overcome these, that's going to bring those receipts back, which, okay, that's fine. But I think initially the bond market will probably respond with a little bit of a sell-off, very similar to what they did in 2016. When he got elected, bonds sold off, rates went up, okay? So I think we're going to have better economic growth due to Trump. He doesn't like regulation. So there's going to be less regulation and lower taxes. Okay, that's good for the markets. It's good for the economy. Not so good for receipts at the Treasury. Not so good for the federal budget. So there might have to be an increase in the Treasury auctions to overcome those deficits. Initially, it may overcome it with tariffs. I don't know. Harris is a little different. I think we're going to have higher taxes and more regulation. So we're going to have, but you kind of know what you get with her. So I think you're going to have less volatility, and I think the return will be a little bit, the absolute returns will be a little bit lower, simply because the tax regime will be a little bit higher and the regulatory regime will be a little bit more restrictive than Trump. But I don't think it's going to be materially different. 2 or 3% a year would be my guess. But again, you're going to have likely less volatility, and that volatility is attributable simply to Trump being Trump. I mean, we could come in today and he's like, I'll turn on the TV and, Trump went to Ukraine and called Zelensky a short little midget sissy.
Yeah.
Now the market's
Someone should make a Trump volatility index to rival the VIX in what it does for option prices. Mm-hmm. Like there should be some way to algorithmically program a Trump volatility index. People would bet on that like crazy.
Yeah,
Trump's been quiet for 2 weeks. Put me 1,000 on.
Yeah, exactly.
Trump
What's
he gonna do next?
The TVIX. The TVIX is way
that's
down.
already taken. There is a TVIX already.
Yeah,
the
TVIX is down. Let's. I got to buy it. Let's see what happens. So I don't think and it's one of those things where people try to because they know what we do and they know what I do. They're trying to hear what they want to hear. Now, personally, I know what I believe. I know who I would prefer to be in. Okay, but nonetheless, it's one of those situations where either way, these companies know how to make money no matter who's in office, right? Yeah. And you look at Harris. Is she a socialist? I don't know. Maybe she is. Maybe she isn't. But what I can tell you is she appears to be a wholly owned subsidiary of Wall Street and the media. Okay, so I don't think that the markets are going to have a bad time with her in the White House because she's a politician and she knows how her bread is buttered. She's going to want to make sure that stays going. Trump's he's a horse of an entirely different color. This is a very historical time that we live in with President Trump. He is you can love him, you can hate him, but you can't discount him. The guy is razor sharp, and he's very passionate about this country and the direction he wants to take it in. Whether you agree with him or you don't, you can't discount that. And the one thing I will say about him is he doesn't have to do this. He doesn't have to do this. He's got plenty of money and all these other things, but he's choosing to do it because I think he actually wants to, do a good job for the country. And I know there's other things. Oh no, he's a power hungry maniac. One of the things, but and that may be some of it too. I don't know, but I think what we're going to see is, as far as the markets are concerned, and I'm going to steal this from Mark Newton because something I've been thinking anyway, and we've been looking at. He's actually been more public about it. Is I think we're going to have, I think we're actually going to finish September pretty strong. I think next week is going to be a really good week for the markets. I think we're going to consolidate into the final week of September. But we're going to finish September right about at the highs, 5,650, 5,700. And then I think it's going to get really, really, really choppy based on events and circumstances that none of us can predict in October. God only knows what's going to come out of the woodwork in October. And I think that could have short-term implications on the market, depending on who they think depending on who it happens to. Just to quantify everything, the Silver Bulletin, Nate Silver still believe there's a 60% chance that Trump wins the election based on the Electoral College. Okay, so as we get closer to the election, we'll see what the bond market has to say. But the bond market, I guess if I had to bet my life, I think it's more likely that Trump will win than Harris. Okay,
yeah.
So that's not that we're going to do anything internally with portfolios between now and then, but that it just kind of appears to be taking on that scenario where he wins, and that's simply because if you look at the polls from 2016 and 2020, how far he was behind in Pennsylvania, Michigan, and Wisconsin, all these sort of battleground states, he was 8 points behind, 7 points behind, and he won those states in 2016. He's ahead or within 1% and all this, so he kind of polls low, but then he outperforms the poll. And in 2020, he was well behind Biden, and he almost won. So, there's this energy that he has when it comes to election day that it just doesn't translate to polling data, I guess.
Yeah. Well, it'll give us something to talk about for sure. So appreciate it, man. As always, see you in a couple of weeks. If you have watched all of this on YouTube, hit a like button, subscribe, all that good stuff. If you're on the podcast, listen to us. We appreciate it. If you would like to chat with someone who can help you with your own personal finances, once again, this is not we're not here to give financial advice or investment advice. This is for entertainment and educational purposes only. If you would like to reach Matt and his team, you can give them a call at 702-655-8300 or go to intelligentinvestment.com. You can also check out some more things on wealthpartners.io/intelligentinvestment. Check out the show, other things like that. But thank you for watching. Thank you for listening. Matt, thank you for talking. Always a pleasure.